celebrating the listing of ZSE Holdings with a friend and colleague of ours, Itai. This is a fellow stockbroker, capital market player, and lawyer as well. Us being stockbrokers, where our lunches ended up being a little bit liquid, and we picked up an interesting tipple. What are you having over there?
This is Glen 15. Yeah.
Ah, nice. Nice. Yeah, I'm having some of the what we toasted to earlier. I think this is champagne. So it's good to be out here and have a tipple on the ZSE's tab. Ranga, you.
Yeah, for a minute I thought you were going to discriminate against me. Okay, let me just.
What is this color?
No, I was just.
What is this colorful drink
I
that you're
was just
having?
waiting for you to do that. I can have this one taken from the set, so that we can just continue. No, this is just red grape juice.
Fruit juice.
Yeah,
Okay.
yeah, just keeping it simple.
Okay.
Yeah.
Fantastic.
Mm.
Yeah. No. Oh, look, we're all analysts in our own right, so we can have talk a little bit about the listing of the ZSE and what else is happening in the economy. But from just what's your take? I feel like we have a lot to be negative about, and a lot of challenges and problems that we discuss. And it's always, I'm delighted to actually be here celebrating a positive development in our capital markets. And quite a few of the conversations I've had with guys here, on the show and on the sidelines have been quite encouraging. I think there is scope for us to make progress in capital markets and in the economy if we engage policymakers more. And the sense I get increasingly is that, the policymaker isn't going to move quickly, but they are open to engagement, and things will happen eventually in the fullness of time. What's your take?
Yeah, so I think you're right, Roof. Firstly, maybe let me start off by saying the listing of the ZSE Holdings Limited on the ZSE main board is historic. Right, it's symbolic. It's a serious signal and message to the markets. It's the first listing we are seeing this year, and also the first listing on the ZSE after quite a while. Right, so I think the ZSE is kind of leading by example. They did not need to raise capital, but they still came to the markets, hence the listing by introduction. And I think the message there is, even when you are not ready for capital, it's also possible to come to the markets, establish a track record, get into comfort space, any rapport with the investment world. Then when you need capital, you've got rapport with the markets, right? And I think that's the beauty with a listing by introduction. So you're preparing yourself for market acceptance when you're raising capital. Many a player contemplates listing at the point of capital requirement, right? But I think the message is, even when you are not ready for capital, right, but you are contemplating growth in the future, you might as well consider coming to market, introducing yourself without raising capital, and start preparing, learn the ropes, go through the drills, so that you are accepted by the market when it's time for listing, right?
Absolutely.
Yeah.
What you're saying is analogous to getting a facility with a bank, even though you don't need to borrow today, but you want to have the facility in place so that if an opportunity arises, perhaps in at some unknown future date, you're not starting from scratch with your bankers. You already have the facility in place. So I think I think it makes sense. This listing by introduction by the ZSE, and also I think it's you've done a great job selling some of the benefits of being on the market. And the other thing that I think a lot of entrepreneurs and business people out there might pick up from this is that once you're on a market like the ZSE, your company in terms of its value is constantly being interrogated, and again, it's just much easier than to do a transaction if you need to offload some or all of your shareholding in a company. And certainly what we've seen on the advisory side is that equity transactions, one of the challenges is actually figuring out what the price of a business is. But if it's listed on an exchange like the ZSE or the VFX and people are trading the shares every day, or even if it's not that liquid and it's only trading once in a while, every other week or whatever, you actually have a reference point in terms of the value of your business. And should an opportunity arise to do a transaction, you know, it's much easier to figure out what a fair price is.
Yeah, sure.
So
Yeah, it's interesting that you're raising that, and even when is what Itai was talking about, it just got me thinking that you know, here we are, three stockbrokers sitting and just talking about how fantastic this listing of ZSE is, but are we doing enough in terms of you know, making relevant stakeholders aware of this opportunity to list on the market and all these advantages that it can bring to them? Because I mean, you know, it's one thing for us to have this knowledge that we sharing amongst ourselves, but I think the people out there, there are businesses out there that are probably at a stage where they can benefit from having getting listed. And we're just before this session, we were talking about, say, Zimplus, and having them listed on the Zimbabwe Stock Exchange. I think one issue that came out was, okay, maybe the market doesn't have capacity to be able to raise capital, but but here Itai is telling us that no, a company can actually list even when they are not ready, or even if they are, the intention is not necessarily to raise capital.
Yeah.
So, gentlemen, are we doing?
Yeah.
Well, you know, Itai, in fact, actually, you know, he's actually a great person to have this conversation with, because you're the sponsoring broker of OK's $30 million capital raise, proving that you can actually raise capital in our markets, as you know, as dark and depressing as the narratives about Zim can be. You know, here's a company that's raising 30 million. So maybe, you know, congratulations, firstly, for being the sponsoring broker for such a big capital raise. Maybe you can, talk us through what that's like, convincing people to pump in that kind of money into a Zimbabwean business that frankly was struggling.
Yeah. So I think, I think it's unfair to say that because the macro environment is challenging, it's therefore impossible to raise capital, right? I think it is possible to raise capital, and I can cite a few historic examples where there have been some oversubscription to capital raises. You know, I think just in the previous year, on the VFX, we saw the Invictus Energy depository receipts being introduced on the Victoria Falls Stock Exchange after a private placement where it was sought to raise about 10 million from the local market, but 12.5 million was actually raised, right, as an example, right? So you can raise capital in Zimbabwe. The OK rights issue had the major shareholders constituting about 73%, right, undertaking to say we are going to follow our rights, which means the only risky portion was 27% of the 20 million rights issue portion. That's about 5.4 million. Uncertain subscriptions,
which is underwritten by a bank,
for which there are three underwriters providing more than $9 million worth of underwriting to cover 5.4 million, right? So even without fully underwriting the issuance, that partial underwriting will see a successful rights issue. And the question is why, right? And I think it goes back to the case. Shareholders are prepared to support their companies if there is a worthy cause, right? I think we all know the problems that Zim went through, and I think this is an opportunity that shareholders think that it can be remedied, right? Mm-hmm. Retail is a place where you need suppliers to come on board so that your shelves are full, right? And then you get margin on what is on your shelves, right? So the trick is to make sure that the shelves are loaded, right? Mm-hmm. So when you're in space where you owe your suppliers and other creditors and your shelves are empty, right? The question is, what do you need to do to bring your suppliers into confidence, right? If there is legacy debt, you haven't paid for historic supplies, and if you're going to be paid, you are happier to bring stock onto the shelves. So I think it's like that. The case is there. It can be turned around, and I think that's what's happening. And coming back to the question that are we doing enough to utilize the capital markets, right? I think a lot can be done. You gave the example of Zimplats, for instance. I actually think that let's look at how our economy has informalized, right? And a lot of our businesses now reside in the SME sector, right? I think our markets should strive to reach out to that sector. We probably need a more junior board, right? Where you've got your smaller guys than your Zimplats and your Deltas and Econets, right? Where we are talking to the drivers of our economy, right? We can't run away from the fact that there's been transformation in the architecture of our economic makeup, right? So we need to be relevant, and I think this is a perfect opportunity for a junior board or an SME board where you incubate these informal sector players. They need capital, and I think the MFI sector, the microfinance institutions, are thriving.
They are,
because of demand for capital in that sector. If capital markets came in to play a role, we would oil that sector quite nicely. And what better way than using the capital markets to do? So I think more needs to be done in that regard. And I'm happy to observe that, from the speech that Justin gave earlier, there's been sort of new issuer training which started in the last year, where they target identify guys who could potentially list and start talking them through the process to say this is how you list. And I think as that happens more and more, right, stakeholders will become aware of the opportunities to use capital markets So I think we should move away from thinking that the stock markets or capital markets are for big players, companies, right? I think what we're seeing in Zim now is a perfect opportunity to actually embrace smaller players, incubate them, and then they can graduate into the main board or the more senior board once they then achieve certain thresholds, be it annual turnover or total assets. Then they can move to the next stage. But we need a mechanism of incubation where we target the smaller players. Yeah.
So, but Itai, how do you do the issue of the cost of compliance? Because you think it's one issue that's usually raised by players in the SME sector.
Yeah, so I'll be quick on that, Ranga. How you deal with it is you differentiate the requirements. You have less onerous or more flexi rules, right, to deal with the junior board. So you are not going to have your ZSE listing requirements as they are now dealing with the big players to apply to smaller players. You need to be sensitive to those issues so that you make it compliance light, right? They still have to tick certain standards, because if you are listing, there are issues where you cannot compromise, like disclosure, for instance. So you need to specify certain disclosures, but maybe perhaps instead of requiring the publication in the papers of, frequent, you make sure information is available on the ZSE portal or on the company's website.
Okay.
Then people know that if I want to check out information on an issue, I go to the ZSE portal.
Okay.
It doesn't cost the company much to furnish the ZSE with information that is available on the ZSE portal, right? As an example, and more can be done to lower the cost of compliance.
Yeah, I think Enimo raised. We had a conversation with Enimo earlier, and I think he raised the important question of what is the value proposition of the ZSE. You really need to be able to sell to a potential listee company, the value that it's going to get. And I think one of the narratives that is dispelling, and I think this is a really important. I think it's actually quite a big deal. For the longest time, the narrative on the exchange has been that you can't raise money here, right? So what's the point? Why list if you can't raise capital? Then how is it a functional and meaningful capital market? And when I think about right, a compelling case could be made that that business had gone through such trauma and was struggling so much that it's probably better off being liquidated, right? But notwithstanding all of its challenges, in this market, they've raised $30 million, right? So what does that tell us about businesses that are actually doing well, where their growth is actually constrained by access to capital? To me, the big takeaway from and the success of its rights issue is that if a business that's in the doldrums can raise 30 million, what about your business that's actually doing well and growing but is constrained by access to capital? It means that you can certainly raise money in our capital markets.
So sorry, Roof. I'm excited by what you're saying, and I'm just thinking another positive that's coming out of is perhaps historically people will say, look, I'm listed on the ZSE. It's a local currency play. What's the point of trying to raise local currency capital, right? It's pointless, so we might as well not. But is just gone out to raise USD.
Even though it's listed on
the ZSE, which is so I think the flexibility around this and how regulators are willing to help companies to allow such things to happen, I think gives hope to markets to say you could be on the ZSE, but you can raise USD capital. If there's USD capital lying around there, you can tap into that. And for me, when all you need to look at is look at banking deposits. Look at how banks are deploying their deposits, right? If you look at the ratios, you see that there is a lot of debt capital sitting on bank balance sheets, right? If you look at, the proportion of liabilities, of bank liabilities, which is used to create assets. In other words, the proportion of deposits that is finding its way to borrowers as loan advances, it's quite minimum. So there's a lot of debt capital. And for me, that signals an opportunity to say you can actually tap into those deposits if you have a solid proposition, right? And if you look at what's happening to chances are it's a reallocation of capital, right? From where it was probably a fixed income play, it transforming into an equity play, right? And if you look at the statistics that Enimo gave earlier, to say around 2020, more than 50% of asset allocation in the market was equities, and it's now down to half of that, right? For me, that signals that there is a lot of allocation to alternative investments, right? Real estate as a proposition, right? So for me, capital markets can follow the money. What can we do as capital markets? We should not be fixated on the traditional equity plays, right? Can we not use the products that are there? We've got special purpose acquisition companies that are provided for in the listing rules that allows for private equity players to come and create liquidity on their portfolios, so that it's an exit mechanism for guys who have gotten into PE, right? So rather than think that people are allocating to PE, how do we help as capital markets? Let's promote the use of SPACs, right, to that sector. We've got real estate investment trusts, right, that are coming in in the property development space. Let's follow the capital wherever the reallocation is happening from equity. I believe that with the products that are there is scope to actually follow the money and participate, so that the capital markets are not suffering because of that reallocation. But we account for that in the global market cap, where we say we've got equities, we've got real estate, we've got fixed, we've got debt, and then so wherever the capital is, we must be there as the capital markets.
I agree completely. Yeah. I think there's a lot of scope to do things differently and to be much more aggressive and ambitious in terms of listings and capital raises. I suspect a part of the part of the challenge really is just the it's post-traumatic, because the market has had these awful periods in its history, like 2021, when it was suspended, when there was no trading for a month, and we lost all mutual and PPC, and the local currency took this massive beating. And I think some of that negativity just permeates the mindset and thinking of capital market players. And when we move on from such difficult periods, sometimes the market in general is slow to actually appreciate that we've moved on from that. And I think that the OK capital raise is a wake-up call, to say, look, no matter what the challenges are, you can actually raise meaningful amounts of capital. There's still a lot of scope for us to do interesting transactions. And I think that perhaps what we as capital market players should be more aggressive about is actually putting the word out there that, we need to change the narrative about the ZSE and the VFEX in terms of capital raising and in terms of the advantages.
Yeah, it's an important issue that you've raised, because the way I see things is part of the migration or the change in asset allocation into other spaces, especially in the alternative, is driven more by fear. It is driven more by fear, and the return stories of some of these alternative investments is not quite clear, and we are yet to hear or to see some testimonies speaking to how most of the players that squished into the alternatives have been able to capture the alpha that they thought maybe had sort of eluded the ZSE. But maybe you could speak to that return story, maybe Itai, that maybe that tends to be the issue raised, that the ZSE has not been able to provide the return. So if you stretch back to say 2008, as part of the value loss story, the market, besides fixed income assets, the capital markets themselves didn't quite provide the safe haven, the protection to the valuation that was taking place.
I'll jump in just a little bit before I hand over to Itai, because I think that's a very interesting point. The question of returns, and one of the things that I've been articulating to folks that I talk to is, if you think about there's the property sector and the construction sector has been thriving, right? And some of the valuations, people ask, is there a bubble? Are these things overvalued or not? If you think about, a property in the Golden Triangle on an acre or on 2 acres, some of those properties are changing hands at more than $1 million, right? But if you think about the property from a rental yield perspective, you'll be lucky if you're getting 5% on such a property, and yet you have stocks on the Zimbabwe Stock Exchange like Delta, like Econet, where the dividend yield is 10% plus. And you can easily buy ticket sizes of $1 million worth of Delta or more, right? And if you look at the price earnings ratios of those companies, they're low single digits. So it's actually much more likely that over a 10-year period, those prices, double, triple, quadruple, vis-a-vis the prospects of that happening to a property in the Golden Triangle, right? So yes, historically, maybe if you look at the last 10 years or post 2008, like Ranga's alluded to, the returns may not have been great. But if you look at the returns that people are making now just from dividends, and then the potential upside should those PE ratios re-rate, that story is not being. A lot of people that I talk to aren't aware that there's this huge gap in terms of the return story between opportunities on the capital markets versus the property market.
No, I agree with you. That observation is spot on. If you look at multiples, right, obtaining in Zim valuation multiples, your price to book value, your price to earnings, enterprise value to EBITDA, Zim is on depressed valuations, big time, relative to regional peers, right? And I think the problem is sentiment, right? And this focus away from equities, the reallocation that we've been talking about, I think because no new money is coming, people are just holding, preserving what they had, and new money is being directed to new opportunities. So there hasn't been enough capital to cause for valuations to reflect true value, right? So it's possible that a company, because it's doing fairly okay, will pay a dividend, and if you compare that dividend to the price, you get a high dividend yield, right? Because the price is depressed and the dividend is decent. It actually tells you that the price, not much has happened to the price. There hasn't been enough trading. If no new institutional money is coming into the market, right, prices are not going to move, right? So I think we need to see, allocations of new money getting into the market to transform this situation. And I think as people drive demand for alternatives and values there become unreasonable, right, there will be a realization to say, but hold on, I'm getting into a real estate portfolio where I'm bargaining for 5 to 8% when I'm getting 10% on the market, and there is potential upliftment from the price going forward. Perhaps it's time to come to the market. So I think it's those who realize that first that are going to
the smart money
to make the money. So I think it's about time that people started realizing that. But I think it's a good thing that, and going forward, I see scope for re-rate. I think Enimo also did mention that our market cap to GDP ratio is actually fallen to below 10%, down from 30% a couple of years ago, right? Yep. So it actually means that the economy is growing, but the companies that are operating in that economy that are on the exchange are slowing down, which is contradictory because they make their earnings from the economy. So if the economy is growing, you would expect naturally that the fortunes of the companies would move in sympathy with the growth in the economy. But what we are seeing is high economic growth, lower market cap, and therefore the market cap to GDP ratio is actually plummeting. That is a signal of serious undervaluation in our markets. And to me, that is a buy signal.
Yep. Is it not a function of the negative macroeconomic outlook? So you might have a situation where even in a more depressed kind of, or in an environment, some companies might be looking good, but if someone stretches 5 years down the line, they're saying the macros, the capital market expectations are probably negative. To what extent are the macros affecting whatever valuation that we're seeing on the markets, and how are other specific asset classes sort of different from the capital markets in terms of that negative outlook that might be in an investor's mind?
So, Ranga, I'm not sure whether with negative outlook you would be growing your GDP.
Okay.
You know, in the first instance, right? Do we really have negative, economic outlook when the economy is actually busy growing? Okay. Right now, if you look at gold statistics, which have just been released, the volumes are up by half a year. I think we are now at around 20,
tons,
1,000 tons, right, of gold, right? It actually shows you that as we end the year, we'll probably double that number. Gold price has been pumping, right? So you've got volume growing, you've got the price growing, so revenue from gold is going to be a good number, right? You've got tobacco. I'm told we had the most decent crop ever.
Record-breaking crop.
Yeah, in the tobacco space, right? We're expecting that we would make a killing. Now, tobacco and gold are probably our major drivers, to GDP, and the numbers are looking good. So, do we really have negative, economic outlook in light of those developments? Really, So I think we've got a depressed populace. Right,
okay. So it's a sentiment issue.
It's just, I think it's we are depressed. Maybe there is fatigue, But look at the growth in the informal sector, right? I always think that we need to capture that. A lot of activity. If you look at the gold numbers, right, more than 60, maybe close to 70% of that number is actually coming from
informal,
the small players, right, relative to the big players. Now, those are the guys that are gonna fuel the informal sector, right? And so if you consider that there is growth in that sector, the people are going to be spending money coming from those windfalls. Tobacco, it's from 130,000 growers, right? Which is a transformation from your 4,000 to 5,000 farmers historically. These numbers are being distributed across a wider pool,
which is why it's driving consumption.
So consumption is gonna, So I'm trying to reconcile the aspect that do we really have negative outlook when we observe this kind of phenomenon, right? I actually think that what is happening on the ground dispels, or rather, contradicts the capital market expectations, right? And then you ask, what is happening on the capital markets that's different from what is happening in the economy? Look at what are the capital markets. It's equity plays, right? Who by who? The big guys, right? Which big guys? You can itemize them, right? But like we said, there is a lot happening in the informal market. And for the economy to reflect what is happening on the capital markets, that's why we need to embrace the informal sector, so that when you measure the pulse rate on the capital markets, it's a good indicator of the pulse rate in the economy, right? Right now, I think there's a disconnect in that our universe of listed players who constitute the capital markets, right, are not that significant players in the informal space, right? And therefore, we've got a bit of disconnect. You see something else happening on the stock market and something else happening in the economy.
Yeah, and I tend to agree with your assessment, and I'll add another layer, which is, I think, just the overarching narratives that dominate the discourse in the intelligentsia, or which is, we're always talking about what's not working, the problems and challenges. They by far dominate the discourse, and to the extent that we talk about increasing gold production or tobacco doing well, it's a footnote. It's almost we talk about them anecdotally, as if they're not actually.
But whose responsibility is it?
And that's us, right? Because we're having the conversations, and we're constantly, to be frank, whining about the things that aren't working. And that's not to say there isn't a lot that isn't working, or that from a policy standpoint should be done differently. But because there is, right? But it's possible that you have a policy framework that is much less than ideal, and that is juxtaposed against a reality where you have sectors that are doing exceptionally well, like gold, like tobacco, where you have an environment where you have an increase in diaspora receipts. You have an informal sector that's actually thriving, right? So yes, there's a lot of unnecessary pain in the formal sector from some, from a policy framework that's much less than ideal. But if we are to zoom out and look at the bigger picture, maybe the macroeconomic outlook is not as negative as we make it out to be.
Yeah, well, it's an interesting one. So I guess again I'll ask the question around whose responsibility is it? So if there's a negative outlook that is being painted, who is responsible for making it positive, and what role do we have to play as market players? Because at the end of the day, it's our market. We are in here.
Yeah.
So if the market is shrinking, we suffer.
Yeah.
And I think like what the conversation that we are having here, that actually it's not all
doom and gloom.
And gloom. Yeah. In fact, you can still do a lot of things, including raising capital.
Yeah. And like I said, Ranga, we've got the policy framework, especially from a capital markets perspective, I think, to be fair, is very generous.
Okay.
Right? It allows us to do much more than
Than
we
what
have been able, or than what we're currently doing.
That's
It would be a different story if we were saying we want to do things, and unfortunately, we do not have enabling legislation, or the regulatory environment is not supportive. But I would say, if you looked at the listing rules, if you looked at the Collective Investment Schemes Act, if you look at the various pieces of what constitutes the regulatory policies for capital markets, there is 1,001 things that can be done, right? So I will not blame policy, right? We now need to say, how do we transform these into opportunities, right? And like I said, we need to follow the money. Whose responsibility it is? I think it's a collective responsibility by capital market players, both the exchange and us, the brokers, and possibly our colleagues in the financial advisory space, to say, let's not wait for issuers to come and knock on our doors, right? Let's approach them. They may not be aware. They are not players in the capital market. These are guys who are busy
running their
operations, and they do not have time to look at the listing rules and seeing how they can benefit from those. But we know that we need to go and say, are you aware that we can provide a solution to your business in this manner, right? So I think that awareness is a responsibility that lies in the hands of capital market players, the exchange, the securities exchanges themselves, the ZSE, the VFEX, the stockbroking community, the financial advisory community.
Interesting.
Yeah, look, I think, and also, it's in our best interests to go out there, do transactions, earn fees and commissions, right? And we are not doing ourselves any favors if we are constantly painting the picture that, it's too hard to do anything. So,
yeah. So I would say, because we know, for instance, we can use special purpose acquisition companies to solve a lot of, problems that perhaps your private equity players face, right, in terms of creating exit mechanisms, right? If you had a discussion with guys in that space, you would be surprised. You could come up with one or two nice packs that are listed on the markets, right? The list goes on, right? You could do more with your REITs. You could do more with coming up with collective investment, structures on the markets, right? You could look at doing a lot on the fixed income side of things. If people are borrowing at usurious rates
from microfinance
businesses, from MFI businesses, why can't you come up with products, debt type of products, where even the MFI guys come and raise money on the markets, right? And then perhaps they can afford to lend cheaper because they are also mobilizing cheaper from the capital markets, and they get support from institutional type investors, right? So I think, we are not using the products that are available in the rule books, right, to solve the problems that are there in the economy. The products are there. The regulatory environment is enabling. The demand is there. The market is there, but things are not happening. So I think that's an indictment on us as players to say perhaps we ought to do more, without blaming the regulatory and policy environment.
No, I tend to agree with you. I think to me, the biggest takeaway and signal from the OK rights issue is that that this narrative that you can't raise money or in Zimbabwean capital markets when a business that has been struggling has successfully raised $30 million US, right? That's, to me, it's a red flag to the narrative that you can't raise money in this part of the world. And I think that you ignore signals like that at your own peril. I think it might actually, when we look back 3-5 years from now at the fortunes of the capital markets, we might actually turn back and say that OK rights issue was the turning point. That's when everybody got that wake up call that perhaps there's a lot more that we can and ought to be doing, and it makes me personally very bullish in terms of the conversations that I'm going to have going forward with the clients that I certainly interact with about what can be done, because you have it's not just hypothetical or theoretical. You can actually point to a business that has raised $30 million US, which is a lot.
Yes. Well, maybe taking the conversation a different direction. What the foreign investor has been a very critical stakeholder for the ZSE for a long time, and the last 3-4 years we saw the direction of flows being mostly out. So given that picture, maybe Itai, that you are seeing, the pointers are all positive in terms of economic activity. Do you think we've got a story to sell to these guys, some of whom are still stuck with funds that they've been failing to block funds?
Mutual and PDC as well.
Yeah. So I think that is a place where I would say there is need for regulatory and policy support.
Okay.
Right? Why? If you look at the reason why foreigners came into Zim aggressively was because of dollarization. Okay. Right? So an investor, a pension fund or institutional fund manager who is allocating funds out of the US, out of Germany, when they were putting US dollars into Zim, unlike putting USD into Kenya, where you first have to convert into the Kenyan shilling and buy an asset which has performance in shilling, and maybe the exchange rate comes down, so there's devaluation in the exchange rate, the asset is going up. When you are converting back into USD at the end, you could be negative, right? Because you have picked up an asset. So you've got asset risk and then you've got currency risk. In Zim became attractive because it removed the currency risk component. So your return was just driven by the asset return, right? So you didn't have a situation where the asset return does well and then currency debits your value, right? You were neat and clean. So that's why they could bring in USD, they could take out USD. When that changed, right, appetite dropped.
Okay.
And how did that change? When we converted the markets into Zim dollars, and we could not support exits through allocating sufficient so that they could. So then that competitive advantage that Zim had, the unique space where your play is just the asset risk, changed. We picked up currency risk in a bad way, right? We had the
most
worst
awful way.
Yeah, in the most awful way, because then suddenly, right, we were probably in space where, guys, because of inflation, there's going to be currency devaluation, and then even if your asset goes up, but because there's devaluation, you're in bad space, and then you go to queue for a very long time, while that Zim dollar that is in the queue is actually being exposed to inflation and further erosion, right? So it actually forced people to remain in the market, because joining the queue became risky business, because you lose value. There is no certainty of allocation, and it's a pity that we took Old Mutual off the equation, because Old Mutual was helping those guys who want to exit to say, I sell my Delta and Econet in Zim dollars, I buy Old Mutual and Zim dollars on the ZSE because it's fungible, instead of putting pressure on our foreign currency reserves. They are now available just for our importers, right? These guys who want out from the capital markets would use a financial instrument, Old Mutual shares. They go and sell on the JSE. You take your money out from Joburg. So the pressure, you are transferring the pressure to a foreign market. Beautiful arrangement, right? But so this is why I'm saying we need policy support, because if I look at Old Mutual's fungibility, I think helped us to preserve our foreign currency reserves and make them available only to importers. Now, when we removed that, we now wanted foreigners to queue, and they were frustrated, so which is why everyone who has attempted, every counter that has migrated from the ZSE to the VFX, right? There is huge demand when an announcement happens that this company is going to migrate from ZSE, because anyone who wanted out sees that as an opportunity to say, let me get valuations happening in USD on the VFX, and let me, as I exit, at least I'm exiting in USD, right? Even if valuations don't make sense, right? So for me, we need to sort that out. The fact that we've had stability and we hear that reserves supporting ZIG are robust, it must translate into convertibility, right? If we have enough USD and gold supporting ZIG, we must be able to see someone exit the ZSE, go to their bank on the day, convert into USD or rand, and take their money out. As long as that is not happening, right, it's sky in the pie. This whole concept of we have enough reserves backing ZIG, right? If I'm unable to tap into those reserves to be able. So if foreigners are able to get out, they will be happy to get in. They are not going to bring money in when they know that they are getting into a trap where they will not be able to exit. So I think the foreign investor narrative can only succeed if we solve the currency conundrum and the ability of our investors or foreign investors to be able to take their money out, right? And I think a low-hanging fruit was the fungibility in Old Mutual and PPC, right? I actually don't know why, we still haven't brought them back to solve this conundrum.
Look, I hear you, and I concur with most of what you said, but I also think that I will differ with you in that, again, we are guilty of being erring on the side of negativity in this regard. Yes, ideally we would have a exchange control framework where that takes currency risk completely off the table, like we had during the GNU. But I also think that the reality on the ground today is, if you look at a lot of the listed businesses, whether they're on the ZSE or VFX, they're doing 80-90% of their transactions in US dollars. And they are paying US dollar dividends. And they are trading at severely compressed PEs and valuations, right? So, if you're going to take a 5-10 year view, because, whatever currency cycles we may or may not go through over the next 5-10 years, I think that the value in some of these businesses, is going to be not just preserved. A lot of these businesses have actually demonstrated that, notwithstanding the challenges we've had over the last 10, 15 years with currency, they've been able to not just preserve their value, they've been able to grow their value. Right? A lot of the businesses that are listed are bigger today than they were in 2008.
Yeah.
Right?
Yeah.
So isn't there a case to be made that, hey, you know what, guys? Yes, we might have a currency implosion in the next 5-10 years. That's a very real risk, and we've seen it happen over the last 10-15 years. But look at the returns, look at the dividend yields, look at the growth of some of these businesses in hard currency. Are we precluding the possibility that there is capital outside Zim that is amenable to that risk return profile?
Okay.
To say, you know what? Yes, we.
Even if you get stuck,
there's currency
years.
risk, right?
Yeah.
And you know, we can wake up and the nostros are now local currency and worthless, but we believe that these businesses will navigate those stormy seas,
Yeah.
and on the other end of that, they'll still be valuable.
Yeah.
And if you're getting in at this price, yeah, it's a good bet.
Yeah. So, Roof, I think to answer that question, you know, the proof of the pudding is in the eating. Seeing is believing, right? If there were such investors, we should be seeing them come in to take positions, right? To fortify what you are saying, right? That it remains sky in the pie, right? Validates, you know, my
But
submissions.
maybe it's
Yeah.
a chicken and egg situation where, because nobody's selling that product, right? Nobody's actually having that conversation, right? I think, okay, certainly for me, when I talk to capital allocators outside Zimbabweans in particular, the conversation just stops at the current question.
Yeah.
Right? They say, hey, you know what? If I wire $10 million into Zim, you know, can you guarantee me that, you know, if I'm
I'll be
up
able to take it
50%, you know, if my equity portfolio is up 50%, I'll be able to exit.
Yeah.
And then I say, well, no, I can't guarantee anything, my guy.
Yeah.
Right? And then that's the conversation stops.
Yeah.
And I don't push back and say, yeah, that risk is there. Price it in.
Yeah, you see, so the problem, Roof, is when you talk to allocators out of Zim, that's a fairly sophisticated, you know, group of investors, right? You're selling, you know, a story to them, right? I would not ascribe a very huge explanatory factor to that in
the
terms of
ultimate
their
decision that they're
decision to invest in Zim. These are guys who have invested in war zones, right?
Okay.
These are guys. The Zim play is not a unique play. You know, they've seen this elsewhere, right? And they'll probably be able to tell you better what's going to happen than you would seated
Because
inside.
yeah.
You know, so those guys will be able to look at it from an outsider, and they've got a very good view, right? They are allocating across currencies. They've got very good ability to discern. They've seen this before, right? We have warm bias, right? We are looking at it inward. These guys are able to hedge, you know, risk using derivative instruments, insurance, elsewhere, which unfortunately that ability, you know, the ability to hedge,
it's not available.
Is not available.
We are
for
fully
us
exposed
because of the non-convertibility of our currency. And where is that coming from? This is why I said we need policy support to be able to tap into the robust reserves to be able to make our currency convertible. People must be able to get in and out easily. If they can, someone can hedge that risk to the extent that they so desire. So if I'm worried 30% about the risk in Zim, I would hedge accordingly, right? But the instruments, the hedging instruments, need for there to be convertibility, which is not there, right? So that is what validates my submissions to say we need to, if we are going to woo foreigners, we need to solve the currency conundrum.
So,
Because yes, people have different risk appetites, and some people's strategy, some investors' investment strategy is about looking for risk. Your hedge funds, for instance, right? But that there are no hedge funds coming to pick up our risk should tell you that there must be a problem somewhere, which is even, you know, causing your risk lovers not to play, to stay away. You know?
Yeah, look, it's very interesting that you're raising that point, because I mean, when you look at Zim, look, fine, investors were coming in because we were dollarized, so there was certainty in terms of the currencies. But even when we then de-dollarized and adopted the local currency, if that was the only thing that we had, I don't think we would have seen as much traffic outward of foreign investors as we experienced in the last 3 years, because there is, like what Itai is saying, there are some hedge funds that would say, okay, fine, not only do we like to take the risk on the underlying businesses in Zimbabwe, but also the currents play. But what is so, what you wouldn't expect an investor is a situation where after taking all those risks, when they want to move out money, they can't. Not for a month, not 6 months, a year, 2, 3, you get a paper. That's the option you get. We are giving you a 20-year paper or a 10-year paper. No coupon. Sometimes it's not tradable or it's tradable. Basically, that's not risk taking. I think that's being reckless, because you're almost assured of losing everything. So I think the issue about engaging the policymakers is about there are certain things that we can't do. When someone brings in the money, you should provide an avenue for them to be able to take out their money. If they lose it because the business that they invested in blew up, they won't complain. It's part of risk taking.
They're bargaining for that.
Yeah. What you can't tell them is after you've done all that and you think, okay, you've realized the investment, you instructed your bank to pay. The bank can't pay.
It's like asking them to bargain to lose their money.
Exactly, because it's 100%.
So even if they love risk, man, you want to love risk because it's rewarding.
Yes, how do you hedge against that?
You love risk because it must be rewarding.
Exactly.
And the reward materializes when you have more in your hands than you brought in. Now, when you can't bring back anything into your hands, you stop being an investor. You become a fool. And for the longest of time, unfortunately, because of the currency issue,
yes,
you would have, because we had two exchange rates, the paro and official, artificially controlled, and that's the rate where your foreigners are entering the market. When that rate was half of what it was on the paro, it rigged the markets in favor of locals. Because if you have $1,000 and you can get twice as much Zim dollars by resorting to the paro market, and the foreigner gets half, and you buy twice the number of shares, right?
Yep.
With the same amount of US dollars as a foreigner. So stock becomes expensive. You are doubling the cost of your stock. Now, for them to be able to get a return that offsets that, right? In an environment where you don't even know if you are able to get your money out. So even if you believe that the asset price is going to reward you for that, but when we remove the certainty of you taking the money out and there is no hedging instrument to help you to even give away part of that return, in exchange for the insurance to say I will get my money out, you stop investing in Zim.
Agreed.
Yeah.
Yep. No, you're absolutely right.
Maybe before I can see that you're almost closing the show, but there's one issue that we think generally as a market we have failed to articulate, and I like the fact that Itai actually spoke about it, but maybe just one angle, the old mutual one. Maybe there were in like a minute or two. Maybe you can unpack how Old Mutual was instrumental in terms of bring foreign investors bring in money, the mechanism for them bring in money and be able to ship out that money. Because I think all that is known out in the public is the reference to the implied rate, which the authorities or the policymakers were just saying it was a leading indicator of the power market. Not only just leading, it's more like a prompt for people to be trading at that level.
Yeah.
But this is that mechanism for me. It's one that I feel that as a market we failed to really unpack or to convince the policymakers or even to share with the public that are still angry about how the stock market can be used to prompt or promote power market activity.
Thanks, Ranga. So I think I'm happy that we have had ZIG stability, for the longest of time, right?
Yeah, almost 6 months now.
Yeah. So what it means is if you brought back Old Mutual and it even listed on the Zimbabwe Stock, and there was an Old Mutual implied rate, chances are it would probably
be insignificant.
It would probably be, where the
supermarkets are at 32.
It wouldn't be wild. What made it wild then was because we had a power market which was constantly driven by money supply growth, local money supply growth, right? So that money had to chase, foreign currency. And it's unfortunate that, Old Mutual was it provided a daily measure of the difference in, or the implied rate between our Zim dollar and either Rand or British pound or USD, right? Not out of a making of Old Mutual itself. It's their share, it's fungible. It's like you can have a bread implied exchange rate by looking at how much bread costs in in Pick and Pay in Joburg, and how much bread costs in Pick and Pay in at same level at Village Walk.
And
right?
Jono used to have the hard-boiled eggs index.
Index, yeah. So you could actually, now are you going to close Pick and Pay because the price of their bread gives you
an implied
rate which is above the official exchange rate, Yeah. But like I said earlier, the thing with Old Mutual is it had actually, because it was fungible, it had become a way of taking, money out of Zim to, anyone who wants to exit, just there to buy Old Mutual. And to make sure that there is constant supply, the pricing mechanism was such that those who want to buy in Joburg could buy in Joburg to come and feed the market, because there is a market for those that want it to take it out. So it was something that was going around nicely, right? And I think the cure to the Old Mutual implied rate, a sustainable cure, in my view, is to implement monetary policy that gives you stability in your exchange rate, right? As we have seen, right? So I would still want for there to be a re-engagement with authorities to relook this, because what it has done is, a lot of pension fund money is trapped in there, a lot of retail investor money.
Almost half a billion.
It's a lot of money. Yeah. Last time I looked at it, it was more than $400 million.
And also to say
worth of Old Mutual and PPC just sitting there, dead capital. No one is getting any value from it except the dividend.
And also to say some of the foreigners, if not most of them, actually, when they brought money into Zim, they actually used Old Mutual.
Yeah.
So that's the same mechanism that they used to bring their money in. And it was really sort of a natural system or mechanism where every time there's always someone who wants to bring in money using Old Mutual, and there's someone who wants to take out money without really disrupting or affecting how the foreign currency management system was working. I just thought maybe since we are here and we may never have that opportunity, we need to just spell it out to say, you know what, Old Mutual was not responsible for the parallel market activities. It was actually providing some sort of a buffer, Part of the activity that was supposed to go to the parallel market was putting pressure on the banks was being serviced by this mechanism.
Yeah, and if you look at, when you tell me that there's $500 million, as an investment banker myself, I look at this could be, I remember banks were prepared to issue out loans if you could provide security from certain
stocks,
issuers, and Old Mutual was one of them. So imagine the amount of credit that can be created by allowing liquidity in $500 million worth of assets, right? Maybe $100 million could be secured, and we were complaining that banks are not lending, etc. But perhaps if we could unlock some of that security, we could stimulate a little bit of, lending activity. So besides prejudice occasioned to holders of those securities, I think it's actually, stifling the amount of liquidity that can flow through credit creation in the banking sector.
No, I completely agree with you. Unfortunately, the producer's jumping up and down just as the conversation was heating up and getting a little bit more interesting. I think there's a lot to the Old Mutual saga. And I think that, and I'll take Inimo's advice. We had a conversation earlier where he was saying that, it's not enough to just engage once on an issue. I think because the, government is a really big ship and it turns slowly. So if you want to see a pivot in any policy action, you have to engage consistently and persistently over time. And I think that Old Mutual is one of those areas that we really need to revisit and continue to lobby and engage, because the benefits of having this trapped capital available and for foreigners to be able to enter and exit our market legally through this mechanism that has a market or has a an open price discovery mechanism. I think it's an important thing that we're missing in terms of attracting foreign direct investment. So yeah, look, you have a standing invitation to come to the studio to continue this conversation. Hopefully we'll be able to get a policymaker to, instead of Ranga on the other side.
Look at this guy. This guy.
Thanks for the advance invitation. Thanks for the advance invitation.
And then we discuss and debate further, because I think it's, foreign direct investment is an important component of our capital markets that's currently missing, and we should lobby and engage to make it happen. So thank you so much for doing this, Itai.
It's a pleasure.
I want to shout out to our sponsor Remax for helping making this happen. Thank you so much. We hope you've enjoyed this debate and discussion as much as we have. Have yourselves a great weekend. Cheers.
Cheers.